Hi, everyone, and thanks for joining. My name is Praveen Krishnamurthy. I'm a certified financial planner and the founder of Empower Financial, an advice-only financial planning firm here in the Bay Area. I work extensively with tech professionals, particularly around equity compensation and tax optimization. Quick word about me. Before becoming a financial planner, I spent many years in Google on the engineering side. So I come from a world that many of you do, juggling compensation trade-offs, dealing with equity complexity, and trying to make confident financial decisions in a fast-pacing environment. That background really shapes how I approach conversations like this. Over the past few years, I've had the pleasure of working with many Netflix employees who navigate this exact same decision each year at open enrollment. How much to allocate to the SOP or SOP, if any. One thing I've learned is that this program is unique in the tech world, and the decision can feel surprisingly complex. My goal today is simple: to give you a clear, practical, and personalized way to think through the SOP allocation so you can make a confident election that is based on your own situation, not on FOMO, not on momentum, or hallway conversations. I have formalized this framework from my own experience with Netflix employees. A quick reminder before we jump in, this session is purely educational. I'm not giving you personal advice or telling anyone what they should do. This is simply a framework to help you think about your election in a grounded and structured way. Also, to be clear, I'm not affiliated with Netflix, and this session isn't sponsored or endorsed by the company. I'm here purely in an educational capacity. Here's how we'll approach today. First, we'll set the context, the actual decision in front of you. Second, I'll walk you through the mechanics of the SOP just to make sure the program features are crystal clear. Third, we'll dive into the core of this session, the 3 C's framework: cash flow, conviction, concentration, which I use with my own Netflix clients. And finally, we'll open it up for Q&A. This is a tight, focused session. The presentation portion should last about 20 minutes, and then we'll leave plenty of time for your questions at the end. So here's the trade-off in front of you. Taking guaranteed cash versus using a part of your salary to purchase options at discount. And remember, the SOP election is voluntary, not mandatory. This structure is also unusual compared to many other large tech companies, where equity is often delivered automatically through RSUs. At Netflix, the SOP requires you to make an active decision, one that impacts both your take-home pay and your long-term exposure to the stock. So, in addition to being a Netflix employee, you're choosing to be an investor in the company. That added choice is what makes this decision worthy of closer examination. Understanding this trade-off is the foundation for the rest of your decision. Let's make sure we're grounded on terminology and the mechanics before we apply any framework. An option is simply the right, but not an obligation, to buy a share of stock at a fixed price, known as the exercise price or the strike price. The spread is the difference between the stock price and your exercise price at the time you choose to exercise the option. So here's how the SOP works. You elect a percentage of your salary during open enrollment. Netflix uses the pre-tax dollars to buy non-qualified stock options at 40% of the grant date stock price. These options have a 10-year expiry. These options vest immediately, meaning they're portable if you leave, and the taxes are due only when you exercise. Specifically, the spread is taxed as ordinary income at exercise. This entire structure, the discount, the fixed strike price, the 10-year window, and the taxation, is what creates both the opportunity and the risk. So let's delve into this a little more. This slide really crystallizes the whole program. Because options cost only 40% of the strike price, you get 2.5 times more exposure than you would through buying the shares outright. That's the leverage. At the same time, the stock needs to rise at least 40% above the exercise price before your investment breaks even. That's the hurdle. So the SOP is neither free money nor a guaranteed win. It's a leveraged bet that amplifies both the upside and the downside, as you can see through leverage and hurdle. This diagram right here visually shows why options behave differently from shares. Shares returns tend to be linear with the stock. For each dollar increase in Netflix stock price, you see a dollar appreciation if you hold shares. However, options, on the other hand, don't have any value until the stock price goes beyond the exercise price. But once the stock price goes above the exercise price, you can see the orange line has a much steeper slope than the blue line. This is the 2.5x leverage in action. I also want to highlight what I call the dead zone that extends all the way to 1.4x the exercise price. This is the region where your ROI, or the return on your initial investment, is still zero. If you consider the tax paid at exercise, the dead zone extends beyond 1.4x. In other words, your SOP election remains illiquid in the sense that there is no point exercising them in the dead zone, which may last for a few years after your grant. This graph is helpful because it highlights why both conviction and risk tolerance matter. Your experience holding options will be very different than holding shares outright. So here's the strategic trade-off in front of you. I want you to think of each row as two sides of the same coin. For every compelling advantage, like pre-tax purchase, leverage, long-term horizon, there's a corresponding catch that you need to weigh carefully. Immediate tax savings, for example, right now, will result in ordinary income tax at exercise. A 10-year growth potential comes with a forced liquidation window, as you have to exercise your options within the 10 years or forfeit them. Similarly, your options vest immediately, but they're just options. You cannot donate appreciated options or receive a step up in basis at death like you do with shares. So they present you with limited tax planning opportunities. Understanding these pairs is essential because it prevents you from focusing only on one side of the story. So before we jump into the 3C framework, I want to reframe a couple of the most important questions that I hear, common questions that I hear from Netflix employees. People are often asking me, what is the expected risk here? Or what is the expected return on the SOP? These are good starting questions, but I think more helpful questions are actually, how does that expected return impact me? Or what does this risk mean for my financial life? The SOP isn't good or bad in abstract. Its suitability entirely depends on your own situation. And that's where the 3C framework comes in. It helps you evaluate the election through these three personal lenses. Cash flow. Can you comfortably absorb the reduced paycheck? Concentration. How does this affect your overall risk exposure? Conviction. Do you have a real investment thesis? Or is the decision driven by emotion or peer influence or some other factor? All three C's matter, but depending on your life stage and goals, different C's become more relevant. What matters is understanding which C is the most meaningful for you right now. So cash flow matters on two different levels. First, does the reduced paycheck strain your monthly budget? Think of mortgage, utilities, childcare. Also, does the SOP allocation limit your ability to contribute to tax advantage savings vehicles like the HSA, 401k, 529? Historically, these vehicles have been great wealth builders for Americans. Remember that all these compete for the same dollars. Second, most of us have near-term goals like buying a home, starting a family, taking a sabbatical that need an extra cash cushion. Does the SOP election lock up your cash and limit your flexibility? That's the key question. If your cash flow is stretched, that's an important signal that you need to consider. I believe each dollar, each bucket in your portfolio has a specific job, whether it acts as a stabilizer or a steady growth agent or an agent for outsized growth. It has a very specific role to play. So when we talk about concentration, we're really talking about how your total portfolio is distributed across these risk categories. It's not just your Netflix options against your total invested assets or your net worth. Here's a very simple rubric that I use. On the very low end of the spectrum of risk, you have cash and cash equivalents, money market funds, and so on. Then come bonds, bond funds, and then you have broadly diversified index funds. And then you have specialized or thematic asset classes like REITs or small cap funds. And then at the very top of the spectrum, you have the highest volatility tier. Things like crypto, angel investments, and yes, your Netflix options squarely belongs here. So here's a good example, a visual example of how risk categories play out inside a real portfolio. The portfolio on the left is more balanced. It has a steady base of cash, bonds, and broadly diversified funds, and only a modest allocation to high volatility assets. On the portfolio on the right, by contrast, is much more top heavy. A significant portion is tied up in the highest risk categories. And far too often, I see portfolios and the distributions to the right rather than on the left. Now, both portfolios might be of the same size in dollars, but the risk profile is dramatically different. This is why concentration is such an important lens for your SOP election. You have to understand what your own distribution looks like before you make an election. If your high-risk bucket grows too large, it can overshadow and throw off your rest of your financial plan. Before moving on to conviction, here's a very important slide that you want to look at and understand. Here's the comparison of the S&P 500 returns against Netflix stock. On the left is the annual return, year by year, and on the right, you have the compound annual growth rate, or CAGR in short, for the trailing 10-year period, which tends to smoothen out the swings. As you can see, Netflix has outperformed the S&P dramatically at times, and it also has been far more volatile. As you can see, the standard deviation of Netflix stock is 3 times that of S&P 500, and year-to-year swings can be significant. In 2022, the Netflix stock went down by 51%. Imagine if you were planning on exercising your options that year, or far worse, if you had to exercise your options because you were running against the clock. Having conviction isn't about believing the stock will go up. It's about understanding the volatility you're signing up for and being comfortable with it. Before making any decision, it's worth acknowledging the role of human behavior. We all are susceptible to these biases. It's very human. For example, familiarity bias. I work here, so I trust the stock. Ask yourself if you would participate in a program, the exact same program, if the underlying stock was from a different company. Or FOMO. Everybody around me is doing it, so I think I'll do it. Or recency bias. The stock has done really well of late, so it will continue and I'm going to participate. So naming these biases is really important as it helps keep your decision grounded. And conviction, finally, is ultimately about how you think through a range of outcomes. The worst case, the base case, and the best case. Can you live with the downside of the worst case? Is the outcome still meaningful and aligned with your goals for the base case? And as far as the best case is concerned, it's just luck. You really should not be relying on it. And the critical takeaway here is to understand the opportunity cost. what else could these dollars be doing for you? That's all important questions that you need to ask. To tackle this, I've created a very simple spreadsheet that I'll walk you through right now. It's an opportunity cost calculator. And here there are 3 tabs. I will be sharing with this spreadsheet with you at the end of the webinar. Let me walk you through it right now. So you have inputs, model, and with the visual, there are 3 tabs here. On the inputs, anything that highlighted in green, you can change it. So here I'm comparing the Netflix stock price, the Netflix options to the S&P 500. I've used the ticker VOO. Feel free to choose any of the ticker that you like VT or VTI. And here I've made 2 inputs for the CAGR of Netflix and S&P for the next 10 years. We'll come back to this in a minute. You also have, you can input your combined tax rate at the time of exercise as well as at the grant time. And finally, you can put the amount that you choose to allocate. On the model side, you can see here's the comparison of how the S&P investment behaves versus the options behave. On the left, you have the S&P, and on the right, columns D, E, F are around the Netflix options. So what you can see here is your options don't even gain any value until you hit the hurdle of 1.4x, which is highlighted in blue here. And then, even though it has value that is greater than your initial allocation of 100,000, if you consider taxes, it is still lower than your ROI. And the column on the right here is how your SOP investment fares compared to the S&P. As you can see, this is a period of illiquidity. For about 5 years, depending on your inputs, this could be anywhere between 3, 4, 5 years, you're sitting on an illiquid investment. Another thing I want to highlight is this stops, the Netflix election stops at row 10 or the year 10, because you have to elect, you have to exercise your options or forfeit them. However, if you have bought stock with after-tax money in your brokerage, you can let it ride. So you're not under the gun to exercise this. For people who are more visually attuned, here's the visual of the same model. You can see this breaks even in about year 4, and you can see based on the input, the Netflix stock in red, the options grow dramatically compared to the S&P 500. But this stops in year 10, and this continues because you can let it ride. And you might be wondering why this is not an apples to apples comparison. Why am I not factoring in taxes here? That's because that's how it plays out in real life. If you have surplus disposable income and you buy stock, you generally let it ride out until your retirement or even further. So feel free to play with this once I share it. Just to give you a quick taste, if I assume that the S&P will return 5% and Netflix will return 8%, this is how it would change. You can see it doesn't change much, but the growth is much more stinted. All right, so going back, just a moment here. Yeah, so going back, this is what I would suggest. Come up with your own worst case, your own base case, and best case. Plug the numbers in and see how you feel about it. Are you comfortable with the numbers? How do they impact the rest of your plan? So these are the questions you need to be asking. So finally, I want to leave you with this. The SOP is a leveraged investment. It's not a bonus. Your cash flow and concentration limits should dictate your election, not the recent stock trend or what others are doing. One of Netflix's core philosophies is top of personal market. That means you have the agency. Choosing 100% cash is a perfectly valid and strategic choice. Choosing an allocation because it fits with your life goals and financial situation is equally valid. There is no right answer, just the answer that fits your life. Before we open it for general questions, I want to make sure you leave with the resources you need. In the chat, I will soon paste a link on the opportunity cost spreadsheet and the 3C self-assessment tool. It's a handout that I've created so that you can walk through your own situation and see how the 3Cs work for you. I'll also share the recording and a slide deck as soon as they're uploaded, so you'll have everything. And while you're reviewing that, I'm going to launch a very quick poll here. It helps me understand what kind of content would be the most supportive for you going forward. Please take a moment to fill out the poll. All right, looks like I'm not able to share those resources right now, but I'll be sure to send them in the follow-up email that I will be sharing shortly. All right. With that, we can open up for Q&A. Feel free to ask any general questions that you might have. If you have any specific questions that have personal that apply to your personal situation, then feel free to reach out afterward. I may not be able to get to all of your questions, but I'm happy to point you in the right tools, directions, and next steps. With that, I have a few questions that some of you have already put. So let me start by answering those. One of the questions I have is, how do you best assess how much risk there is in the SOP election? As I said, this is not about how much risk there is objectively in the SOP election. The question is, what does it mean to you? So you have to come up with your own distribution for your risk allocation across your portfolio. And then you need to see where this sits and how does it tilt the balance of your yeah. So just one. So the links obviously are not clickable on the screen because they are through the Zoom window. I will be following up with all the resources, the handout, the spreadsheet, as well as the recordings right after the upload happens. So bear with me on that. Okay, so the next question is tax deferring benefits. How do I calculate this benefit? And somebody says they have a spike right now and it will go down later. Does it make sense to go in? Again, the opportunity cost spreadsheet should be able to model this for you. You can put in your tax rate right now and then what it will be at excise time. That should give you some sense. But an overall philosophy that I generally have around taxes and investments is, don't let the tail wag the dog. The tail being the tax and the dog being the investment. So you don't want taxes to determine your investments. It makes sense to keep taxes in mind, but don't make that the sole decision factor. So yes, there is a very tangible benefit by electing to SOP right now in terms of tax, but if you're far away from retirement, if you're going to be in the same tax bracket for the next 10, 15 years, then it's a wash essentially. There is no significant benefit of having the arbitrage. There's no arbitrage, so to speak. There's some questions in the chat about excising. I'm planning to do another event like this, a webinar, where I solely talk about what happens if you are sitting on a ton of options, which I have clients for, and we are going through the same exercise about how to excise in a way that is you're de-risking effectively your portfolio and keeping taxes in mind. So I won't be addressing questions on excising or how to kind of manage the concentration that you already have right now. That will hopefully follow in the new year. somebody missed the first half, they were late to join, yes, you will have the recording and the slides as well as the other additional material. Some more questions. Somebody asked, assuming retirement is less than 10 years away, how should that SOP allocation affect as my retirement draws closer? Again, there are multiple factors here at play. One is the time horizon. The other one is what does your asset base look like? A key question for anybody on within 5 years of retirement or so is how dependent is your retirement and the quality of your retirement on your SOP election or your Netflix position. If it's too dependent, then you want to consider that. Do you have flexibility? Are you going to be 55 and do you have flexibility to work a little longer if things don't pan out as you expect? Or do you have some hard deadlines because of age or health or other reasons? So these are the factors that come into play. So yes, definitely retirement is an entirely different ball game. Your risk appetite is going to be different. You're not accumulating anymore, you're decumulating. So that means that there will be a lot of unknowns. So definitely pay some attention to the cash flow during your retirement before you make an election right now, knowing that the retirement is close. The next question is for somebody with a good chunk of option, but is still bullish on the future of Netflix and plans to continue options next year, how should I think about my allocation? Again, I would definitely go back to the slide where I had the two portfolios, and you need to come up with your own portfolio distribution, risk distribution, and see how this tips in the favor of increasing the risk, or is it still manageable? That is a key consideration for somebody who is in your situation with sitting on a good amount of options. Of course, timeline, asset base matters. Similarly, a question was, what is a good percentage of net worth to have in a program like this? There is no universal answer for this because your timeline matters, your asset base matters. Let's say somebody's net worth or invested assets is like 12 million. 25% of 12 million is very different than 25% of 6 million. So it all depends on your asset base, your obviously your personal risk tolerance, as well as your time horizon. But in general, for most clients that I work with who are mid career, mid to late career, a number that I generally throw out without having a fully informed picture is about 20-25% in the risky assets. So make sure that when you're counting your other risky assets like crypto, angel investments, or other single volatile stock picks, those are all very important. They go in the same bucket. Somebody asks, why bet on the SOP when index funds are so reliable? That is the question that you need to ask yourself. As I said, every portfolio demands a little bit of risk. The fact that you have money and you want it to grow means that you need to take that risk. Now, how much risk you take is completely dependent on your risk profile and your own situation. So again, if you're completely risk averse and you don't want to have anything in the speculative bucket, that's totally fine. There is no universal answer. The question is, how comfortable are you with the risk that you're taking on? And more importantly, being very well informed about the risk that you're taking on. Those are the considerations. Somebody asks about paying tax and diversifying concentrated position to manage the risk. Again, hopefully this is something that I will address in the webinar about diversifying or moving away or exiting the program that you're sitting on. Somebody asked about the benefits or pros and cons of Netflix SOP versus options, general options. They call it LEAPs, which are just long-term options, put and call. What are the benefits of that, or how do that? Well, they share many of the same characteristics. With a Netflix SOP, you're sitting on a single company stock. It's bought with pre-tax dollars. Whereas if you go buy options outside, it's not with pre-tax, it's with post-tax dollars. You have to understand your own risk profile and your own risk across the spectrum of your portfolio. But LEAPs or any options like call and put options, they have a few things that all of us need to be aware of. And it's generally not recommended for 90 or 95% of the people because they are extremely risky. It has a very steep learning curve. It's very easy to get your fingers burnt and trying those. It's not something that I have extensive experience myself with. So you need to be careful. You need to understand what you're kind of getting into. It all hinges on, are you aware of the risk and are you okay with the risk? Those are the two primary questions that if you are comfortable with that form of risk, by all means go for it. But make sure that your entire plan is very balanced despite the risks that you're taking on. So some more questions that have been asked live. Let's see. What are some typical allocations you've seen from Netflix employees make? Have they been happy with the decision over time? Well, let me tell you this. Hindsight is 2020. There are people who have been very happy with their allocations, and there are people who are kicking themselves for not allocating enough. That's because we are just looking at the past. If I had a crystal ball, then like I would happily share that. But if you are new to the program and if you're a little nervous, start slow is my if you choose to kind of go with it, start slow, because your experience of holding this and seeing the ebbs and flows as the market, as the stocks goes up, or seeing that is a very visceral kind of feeling that you want to get used to before jumping whole hog. And again, typical allocations, there is no such thing as typical allocations. You might be a dual income household bringing in more than $500,000. You might be a single income household with like a bunch of responsibilities. So allocations really don't matter. It's what matters is how does the allocation impact your own personal situation. Start slow means that you allocate what I call typically play money, the money that assume that the worst case will happen and start slow, and if you don't see it, well, use it as a lesson. Okay, I'm comfortable with risky assets. I'm not comfortable with it. There was saying that your money should either work for you or it should teach you something. So just make sure that your money is at least teaching you, if not kind of compounding and generating wealth for you. So that's my take on that. Are all the gains on SOP taxed at regular income as opposed to LTCG? Yes. If you hold this, there are three different forms of exercising. If you hold on to the stock, anything that you hold after exercise is long term, but depending on the duration. But again, I'll go into the mechanics of selling and exercising and considerations at a later webinar. Would we lose money if we exercise a stock when you bought it at 200 and now it's at 1200 and you haven't exercised? Yes. If you don't exercise stocks, you're essentially forfeiting the options. Your options are use it or lose it, and you have a 10-year expiry window for that. And when you exercise, you have no option but to pay taxes. On the other hand, if you had stock, there are schemes like deferral of tax gain or donating those. So with options, unfortunately, tax planning is very limited. You take the tax hit and exercise or forfeit them. Can you please explain exercise and hold versus exercise and sell? Again, exercise considerations are, I know a lot of you have been participating in this program for a while. I know there are really important questions for you. So I will do a webinar solely focused on the exercise considerations at a later point. Let's see. It looks like we are mostly there. Somebody asks, I need help figuring out right cash versus options mix, looking for some recommendations. Again, I cannot give you very specific recommendations because I don't know your financial situation. But the most important thing is using the handout to walk through the 3 C's for yourself and seeing where you sit. And if you need a sounding board after you walk through after you review the material, after you walk through, then definitely feel free to contact me. I can kind of, act as a sounding board and give you share my thoughts. But this is not the forum for me to make very specific recommendations. Okay, let's see if there are any more questions. All right, there are a couple more questions. How do we reach out to you directly for additional questions? Well, you'll be getting an email from me with the recording and all the material, so you can respond to that email, or you can go check out my website and see how you can contact me. There are different ways. One question is, do you only pay taxes on the spread at the point of exercise? That's right. You pay only taxes on the spread portion. Is there a calculation that along with the 3C framework that we can use to help determine the right mix of cash? Unfortunately, it's not formulaic. It needs a lot more extensive understanding on, like, what we need to model scenarios on how this is going to pan out. So that's something that I cannot model in a single, like, spreadsheet. It's a holistic calculation that I make for my clients. But for you, the recommendation is come up with your best case, your worst case, and your base case. See how you feel about them. And for a very specific reason, I've left the modeling in dollars and not in percentages. It's very easy to think about a 15% return versus a 12% return. It's very abstract. But when I actually look at it in terms of dollars, if I put 30,000, it will be only 38,000 in 6 years. Am I comfortable with that? That is a question. So you want to be looking at it as in terms of dollars, what it means to you, and what can those 38,000 or 30,000 be doing for you? What else is happening in your life? So it's a very personal question. So I don't try to project, or I don't give numbers. I don't try to be prescriptive generally. Is SOP considered a risky asset? Yes, it is considered a risky asset because it's a single company. There are different types of risk. One is illiquidity risk, then there's a concentration risk. So there are different risks layered in the single program. So I definitely consider it to be a risky asset. Are the blue columns in the spreadsheet editable? Well, you can edit what you like. You make a copy, and you can, if you're a wizard, feel free, have at it. But to make it simple, I keep inputs on the first tab only. The green ones, you can edit it, and everything else should flow. So again, if you have questions on the spreadsheet itself, feel free to reach out. I'm happy to answer them. I know you say tax tail should not wag the dog, but is the new higher salt deduction worth any special consideration to consider a SOP election to take? Yeah. So very quickly on that, there's a salt cap deduction that is going to be relaxed with starting 2026, tax year of 2026. It basically, you get up to 40,000 if your earnings are below 500,000, I think, or AGI is below 500,000, MFJ, married filing jointly, and it phases out at 600. So let's say you are at 605 or 550 in total income. Does it make sense to put 50,000 in your SOP and bring your taxable income below whatever, or AGI below 500,000? Again, this is a complex question because what else is happening in your life? Is how disposable is that 50,000, and what else would you do with it? If you were to go and buy a Tesla stock instead of investing, or if you were to sit it on cash, as I said, most people are, they have high concentration assets, and then they're also sitting on a ton of cash because they're unsure. So what would you do with that? That's the question. And it's not the only way to bring your income down. There are different ways to. So is this the best vehicle for you to bring your AGI down? Is another question that you have to ask. There are different ones. So again, I don't have your personal situation in front of me, but and you can model these things far out. You can say, like, if this continues for 10 years, what would it be like? So these are the considerations that I would take into consideration. Yeah. For someone who's early career, what is the rough percentage? Yeah. So in the spreadsheet that I've or in the handout, I've broken it down by early to mid career, mid to late career, and late career / pre-retiree, because they all fall into these buckets. I'm not saying this is like this is you, but you will be able to see where you fall. For somebody who's early in their career, the C that is most relevant for you is cash flow. That is the most relevant cash flow. And you might have big purchases down the line, buying a home, a wedding and whatnot. So you want to consider, again, it's not just short term. Putting 50,000 or 20,000 away, it's not just a decision that you make this year, but that 20,000 is illiquid for the next 5, 6, or 7 years, right? Because it is in the dead zone. Now, you have to ask yourself, will that impair my ability to do something in the next 3 to 4 years, buying a car or taking a sabbatical? So it's not just immediate cash flow, but the cash flow and the liquidity for the next 5 years or 7 years until you can actually exercise the SOP. That's the question that you need to ask yourself. Moving on, we heard you fired early. What learnings? great topic for another webinar. One of the questions in the poll is, would you like me to do other events like this? I'm happy to talk about it. Also, just a note, if you have any questions, any suggestions for topics in the future, feel free to write, or if I can improve this in any way, this presentation for next year's open enrollment, do write to me. I'm happy to answer and happy to kind of take your feedback into consideration. I'll definitely be happy to talk about my own journey at a different question. Are we allowed to buy or sell company individual stock outside the trading window? This is something that you want to ask your HR. I'm not too sure about this. I know that there are blackouts or open and closed windows around shares, earnings calls. So I'm not sure how it plays out in Netflix. It's a question for your HR. For someone who retires from Netflix, will they be able to exercise in the next year at tax? Yeah, definitely at a lower rate. This is definitely a case, which is why I have in the spreadsheet, there is a way to model, just very quickly, there's a way to model your tax rate now and at the time of exercise. So you can plug this in. And again, remember that retirement is a very different beast because, excuse me, because your cash flow is primarily, because your earning potential, you've said bye to your earning potential, you've left your job, and you have to live off your assets or other social security and what have you. So your ability to take on risk, your ability to move money from one to asset, you're also very tax sensitive in early in retirement because you're things like IRMA, things like you might be planning for Roth conversions. So think about it holistically. Yes, you can redeem or you can exercise your options at a lower tax rate, but how will that impact the rest of your things? Like, are you going to pay a lot in ACA premiums because your ordinary income is very high? So those are the considerations that you need to have in mind. But generally, yes, it does provide an arbitrage. Again, I'm not the biggest fan of let tax kind of wag the investments. So, you need to take a holistic picture again. As the stock grows and our holdings increase, what factors should we consider when making the decision to exercise early to secure a profit, reduce exposure? Yeah, so basically somebody's saying, hey, if I'm sitting on a bunch of options, but they're still 3 years out, should I just exercise it right now? And the answer is yes. You want to think about, yes, not for exercising, but yes, for considering to de-risk your portfolio. If your portfolio is looking very top heavy, then you want to de-risk your portfolio. And there are multiple ways to de-risk your portfolio. Obviously, you can sell some of this, there are hedging ways to hedge your basically bets, or, what you do with your current savings. Instead of buying more options, you buy something else. You buy the something on the left side of the spectrum or the bottom of the spectrum, risk spectrum, right? So there are different ways to de-risk a portfolio that if you think your portfolio is too risky and you have too much exposure. So I definitely advocate that. It's not timing the market because you're taking each year, each situation. You are a different person. You might have kids this year, or you might be retiring in 10 years, or your spouse decides to take a break. So whenever big life events happen, you need to revisit this, like, what is my risk and what was my risk and what is my risk, right? So you need to assess that and you need to make suitable changes. So that's I keep coming back to that graph with my clients all the time about what is your risk right now and are you comfortable with the risk. All right, looks like that is somebody responded to the question about trading window, about employee trading. It looks like you cannot, but again, best to verify with your HR. Okay, sorry, one more question here. What about thinking of keeping the risk static as you sell old stock options, buy new ones? Sure, yeah. I mean, look, there are different risks that you're taking on. Risk is not a single term. It means many different things. If you are sitting on a bunch of options, you are at the risk of basically that money going down. There's a concentration risk. If you're buying new stock or options, you are in the illiquidity risk. So there are different types of risk, and you need to understand which risk is applicable to you right now. For example, if you're 35 or 40 and you have a time horizon of 20 years, you might be okay with a certain type of risk, a concentration risk, because even if things go south, you have the age on your side and the time on your side to make up. But if you're 55 or 60 and closer to retirement, maybe the concentration risk is not acceptable to you or not palatable to you, right? So it's understand the flavor of risk and understand what it can compromise about your financial situation, right? It can affect you in a very particular way. So understand if that you're shielded or you're shielding yourself a little bit against that particular kind of drawback. Can you time bound the stock excising, only want to excise? I'm not sure if I fully understand this question. Can you time bound the stock excising? I only want to excise stock from 2025, but not from 23, 2024. I'm not sure I fully understand this question. But generally speaking, you can excise your options anytime. As long as the excise price is above the stock price is above the excise price, you can excise. But remember, there is a dead zone that extends beyond. So you want to be cognizant of taxes. You want to be considered, you want to understand why you're doing that. Again, all excise considerations. Hopefully, I'm going to put together another webinar in the new year, and these questions will be far more applicable then, and I'm happy to answer those then. Okay, at this point, looks like those are the questions that I've had. Hopefully, I've gotten to all of them. Again, if you have something specific, or if you have questions around any of the material that I've shared, please reach out. I will be sending these as soon as I have these uploaded and ready to share. I just wait here for a minute or two. So if you have other questions, feel free to kind of hang on and ask me, or anything else in the chat. Good. A lot of thank yous. You're welcome. I'm happy to be sharing what I already kind of use and apply with my clients.